This is Sole Trader Final Accounts from the 2014 paper, question 1. So on the left hand side of the screen I've laid out the blank document that we're going to fill in with the basic headings. I'll do the rough work down here and then you can see the rest of the information from the question is over here. So we start with the adjustments and we do the adjustments one by one, and as we do the adjustments we're going to bring in the things that we may need to adjust. We'll do those, and then at the end in part 2 I'll then put the rest of the information into the blank document that I'll have filled out. We don't worry about adding up at this stage. So first of all, number 1, closing stock is 80 grand, no record for goods in transit. The invoice received showing recommended price of 48, which is cost plus 20%. So 48 is 120%. So if you divide that by 120 and multiply by 100, or 4/5, you'll get the actual total. So just do the maths down here. So 800 times, so we divide it by, multiply 100 and then divide it by 120, and that gives us the actual figure. So 4,000 is what the original figure should have been. So 4,000 is our closing stock, and that, I'd say that's the figure that has to be added on to our closing stock. So it's 80 grand plus that, so the closing stock is 84 grand. And in our current assets, we're going to put in the same figure. So we've got depreciation. And we've obviously sold a van, so we'll need to look at all the things that have to be changed. So we have vans, the provision for depreciation. We'll have to work out, did we make a profit and loss on disposal? And then we'll have to work out our depreciation expense. So the vans at the beginning cost 90 and then their current value is 78, so the provision for depreciation is 12. So provision for depreciation starts off as 12 grand. The van figure starts off as 90 grand. Now, then we got rid of a van and we would have bought a new one. So a van which cost 40 was traded against a new one costing 46. So we take away 40 and we'll add on a new one for 6, or 46. So that means that the total value of our vans now is 96, so we can put that straight into our tangible fixed assets. Right, so now we need to start working out our provision for depreciation on the one that we sold. So the van originally cost 46 or 40 grand. We multiply that by the annual depreciation. It says the annual depreciation is 10%. And then we had it for how many years? So it was sold on 31st of the 3rd and we bought it on 31st of 9th 2010. So that means we would have had it for 3 months 2010, all of 2011, all of 2012, and 3 months 2013, which is 2.5 years. So that's, and again, if you can do these numbers in your head as much as possible, it makes life easier. So 10% times 2.5 is 25%. 25% of 40 grand is 10 grand. So the depreciation when we sold was 10 grand. And that means our disposal, when we work out our disposal, the thing originally cost us 40 grand. Minus the depreciation of 10 grand, and then what did we get as a trade-in for it? An allowance of 16 grand was given for the old van. So when you add that together, that means the thing was worth 40 minus 10 is 30 grand. I got 16 for it, so that means I made a loss of 14 grand. So I'm going to put that loss in here. That's an expense associated with vans, so it's a distribution expense. and I've put it into my provision for depreciation. Now I need to work out my depreciation expense for the year. So I've got three different types of vehicles. I've got the continuing. These are the ones that have the beginning, that still have the end. I have the new, and I have the old. So the continuing. At the beginning of the year, I had vans worth 90 grand. The one I got rid of was 40 grand. So therefore, there's 50 grand that are continuing. 50 grand by 10% is 5 grand. The new. So the new one cost 46. The date it happened on the 31st of 3rd, so I would have had it for 3 quarters of this year, 9 months of this year. So it'll be 46 grand times 10%, and then times 75.75, which is 3 quarters of the year, or 9 months. And then the old one. So the old one cost 40 grand. The annual depreciation is 10%. And I had that for 1 quarter of the year, so I multiply that by 0.25. So that's the depreciation expense. The total is all those added together. So my provision for depreciation, I had 10 grand taken away, and I'll add on the depreciation expense for this year, 9450. So the figure then that goes into my depreciation here is the 12 minus 12 grand minus 10 grand, and then plus the 9450, which means the net book value is going to be that, take away that. And then we go to do our depreciation expense. So 9450. Okay, on the allowance. Now let's just see with any other mistakes. The check for the net amount was entered in the bank, was incorrectly treated as a purchase of trading stock. They were the only entry made. So I've now put it into the van account, so I need to take it out of purchase of trading stock, so I need to reduce my purchases. So my purchases figure as it is now is, where are we now? Purchases and sales. So purchases 530,400. We have to take out the check that was paid. Now the new van cost 46. We got an allowance of 16, so therefore we gave the old van plus a check of 30 grand. So we take 30 grand away from our purchases. Moving on. So that's that dealt with. So now we got suspense, and suspense is happening in 2 areas. Let's just see if I just clear that. Okay. So suspense is a rise in correct figure for mortgage interest, although the correct entry made in the bank account. And then somewhere down here, it'll say we have to provide for mortgage interest due. Okay. So we're going to deal with that at the same time because mortgage interest is mentioned here. So we need to work out the amount of mortgage interest we should have paid. So, and this is the figure that's written down, 1500, and that figure you'll find is wrong, and we need to go and fix that. So the mortgage is 200 grand, including an increase of 60 received in the 1st to the 4th. So there's 2 mortgages. There's a 140 grand mortgage, which you would have had for a year, and then there's a 60 grand mortgage, which you would have had for part of the year. What part for, on the 1st to 4th, we would have had it for 3 quarters of the year, and the interest is 6%. So it'll be that figure times 6%, and then this figure times 6%, and then we had it for 3 quarters of the year, so multiply by 0.75. So that's the total interest. So when we come to our interest here, interest paid and interest due, the total figure here has to be 1100 when I add these 2 numbers together, or 11,100. So how much was paid? It says here we paid 1500 for the first 3 months. So during the first 3 months we had this 140 grand. Okay, we had the 140 grand mortgage. So we would have multiplied that by 0.06, that's 6%. And then for the first 3 months is a quarter of the year, so I'll multiply that by 25. I've got a mistake there in my formula, times 0.25. So 2,100 is the amount that we should have paid. We've written down that we actually paid 1,500. So the 600 extra has to be added in. So the amount paid, I'm going to put in here, of 2,100. The amount extra that is not paid, that is due, is going to be the figure we should have paid for the year minus the amount we paid. So 9 grand is interest due. I'll put that into my current liabilities. And it's not debenture interest due, it's mortgage interest due, so I'm just going to call it interest. Now, how does that affect our suspense? So where is the suspense? Suspense is mixed in with salaries and general expenses. So when we did, if you notice, it's on the debit side, so it's expense. Mortgage interest is also on the debit side. We should have put 2,1 in here. We only put 1,5, so we need to put an extra 600 in here. So if you debit this 600, means we'll be crediting this with 600, so I'll be taking away 600 for the 90 grand. So that means salaries and general expenses will be minus 600. Okay, so it's 90 grand minus 600. The minus is because it will be on the credit side. Now the second one then is correct entry made in the bank account, so we've dealt with that. 2 grand paid to PRSI entered only in the bank account, so I need to deal with the 2 grand paid to PRSI. Now PAYE and PRSI and USC, that's credit. 2 grand paid to that would have been a debit entry here and a credit in the bank as we spend our money. So we've done the credit in the bank, we didn't do the debit here, so we'll do a debit here, and the corresponding credit entry is going to have to be in the salaries and general expenses again on the credit side, which again is going to make it smaller. So I'm going to take away 2 grand from the salaries and general expenses. So put that into administration. So that's so it's 90 grand minus the 600 for the mortgage interest and then minus the 2 grand for the PAYE and PRSI. So if I go to my current liabilities, PAYE, PRSI and USC, the figure at the moment is listed at 3.8. We've paid off 2 grand of that, so the figure is now 1.8. So we've got salaries and general expenses we've dealt with. So that's that one. Moving on. Goods at retail price of 15 grand were returned by supplier. Selling price is cost 20%. So there's a number of things that need to change. So seller issued credit note showing restocking charge of 10%. So no entry made restocking charge. So that means that everything else is done right. So the two things we'll have here is restocking. And now this is goods were returned to return to a supplier, so there'll be purchase returns. So the restocking will be put in with purchase returns. And because the supplier owes a different amount, we have creditors. Now how much less do we owe these? Because our purchase returns will have to be taken away from the purchases figure we have up here, and our creditors is also going to have to be reduced. So they were retail price, so we need to work out our cost, our profit on it, and then our selling price. And we're going to have to work this out in percentages. So selling price we know is 15 grand. and the selling price was cost plus 20%. So the profit is 20%. So in terms of, so that's 20%. Selling price is cost is 20%, so that's 120%. That means the cost is 100%. So this number here is 120%. So if I divide that by 120, that gives 1%, and then multiply by 100, that gives us our cost. So I'm going to divide that by 120 and then multiply it by 100. So that means the profit is 12,500. Okay, so that the 12,500 is the cost. That's the figure that's relevant here. And now just quickly checking again, the return selling price was, okay, so we got a credit note showing restocking charge. No entry made with restocking charge. So we assume that the purchases has been reduced by the 12,500. We assume that our creditors have been reduced by the 12,500. But now we have to add on the fact that we're getting charged money for the restocking charge. So creditors at the moment is 111 grand. No, 110. Now we need to add on to that 12.5 grand times the restocking charge of 10%. So that's what our creditors are, and now we have to add on the same figure, which is 1250 to our purchases. So I'll just add this in here. If you do it in an exam, and you end up with a situation where I have to change a figure that I've already altered, just put a single line through it, put the correct figure to the side. You'll always have lots of room on the page to do that, and the examiner won't take marks away from you from that. Okay, so that's that one done. Goods retail price, I've done that. Provision made for mortgage interest due, we've dealt with that. Now, 25% of the mortgage interest refers to the private dwelling, so that's going to have to be included with drawings. So drawings at the moment is 41,250, so I'm going to put that number in there to start with. We're going to have to take away from that a quarter of the money spent on the mortgage. So the money spent on the mortgage is, oh, we have the wrong figure there, sorry. When we worked out our mortgage earlier, so when we worked our mortgage out, we said 9 grand was due, we paid that, so the figure for mortgage should have been, okay, so that's the amount that we've used up. We have to take away a quarter of that. So the real amount for our mortgage, we're going to have to include that here in our calculation. So I'm just going to insert a line here. So we're going to take away our mortgage, our drawings. So the drawings is going to have to be a quarter of 11,100. So now our actual mortgage expense is going to be the 2,100 interest paid minus the drawings, and then plus the amount that we still owe, the 9 grand. Oh, I've got to correct that. Do that again. So not correct. So that's the real figure for the expense. So that 2,775 is a minus number. We're going to put that in here with our drawings. We'll be adding that on to the existing drawings I have already. Patents, which incorporate 3 months investment income, is written off over a 5-year period. So we know that patents are intangible fixed asset. And we're writing some of it off, so we're going to include that in as an administration expense. So we need to work out, look at our patents, and then we need to deal with our investment income. And any investment income that hasn't been paid for is going to have to be included for as well. Okay, so our patents at the moment are, patents are 40,400. Investment income at the moment is nothing, so investment income would be a credit entry, so that means that we would have, it would be in the credit side, so if we've put that in with our patents, so that would have been a credit entry put in with our patents. So to get rid of it, we'll end up having a debit entry in our patents to take it out, and we'll put it into a new account we're going to make up here for investment income. And then we're going to provide for the extra investment income that should have been paid because it wasn't actually paid for. Now, it doesn't say anything here. It says, for example, provision for mortgage interest due. I would assume that you should have provided for investment interest due. So I'm going to do that. I'm going to put a note with it in the question. So up here, I'm going to say investment so the amount due, and I'm just going to say, let's say, provided for under conservatism rule, or let's say concepts. The accounting concepts say that any expense must be anticipated, so even though the examiner hasn't asked for it, you would need to make sure that you include that here. So our investments, 3% investments taken on the 1st to the 4th. The investments is 100 grand. We should have received 3 grand for the year. Now the total for the year is going to have to be 3% of 100 grand. We only had it for 3 quarters of that year, so 1st to 4th, yeah, 3 quarters. So that's 2250 is the total for the year. We have received, it says 3 months investment, so that would be a third of the 2250 is the amount that's actually been paid. So the amount that's owing is 1500. So I'll put that in as a current asset. So how does that affect our patents? So we said that the patents would have originally had a credit entry for the investment income because incomes are all credit entries. So we're putting a debit to take it out of patents and put a credit in the investment income. So we're going to add it onto the 4400. And it's only for the amount paid. Okay. So, and then we have to write that, and we have to take away a fifth of that figure. So that is that's the patents figure, and then we get a fifth of that, 2. So we'll take that number away. So the final figure we're going to have is 32,920. And the write-off is the 8,320 we've written off here. Now obviously your rough work, you leave your rough work something like this, and that shows the examiner where the number came from. So if you, for example, instead of adding the 750, you took it away, or if you had the wrong figure for the 750, once you've shown what you've done here, you're still going to be getting a lot of marks for it. So make sure you don't exclude that from your information. Next, provide for depreciation of buildings 2% of cost per annum, and it was decided to revalue at the end of the year. So we'll do because we're revaluing at the end of the year, we'll do our depreciation first, and we'll come up with a depreciation expense. Okay. The buildings cost 640. That's 2% of cost. It's not 2% of book value, which would be reducing balance. That'll be 2% of that. So it's 2% of 640. So up here are my tangible fixed assets. I have buildings. Now, I know because it's revalued, we're going to have 0 in the depreciation, and we're going to have the new figure here, and we're revaluing it to 720. So that means we're going to have 720 in our book value. So we need to have down here, we need to have a new finance by item. So the revaluation reserve is going to be the difference between 720 and 640. That's how much the buildings have gone up by, and as well as that, we're going to add on to that the amount of depreciation that we've had to cancel. So we had 545 taken away from 640, so that's 95 grand in depreciation up to this year, and then plus the depreciation of this year of 12,800. So it's plus the 12,800. Let's see. Plus the 95 grand. Okay. Just checking that there. Yeah, that's grand. So we've done that. Goods withdrawn from the owner for private use, retail value of 3 grand, which is cost plus 25%, were omitted from the books. So I'll need to take away, so that's the retail value is 3 grand, which is 125%. So divide that by, so we need to, that 3 grand is 125%. So we need to divide that by 125 to get 1%, and then multiply it by 100 to get what it cost. So that means that, and that was taken out during the year, so that's going to be taken from purchases. Again, another adjustment to our purchases. Minus 2,400. Again, you would have just put a line through the figure that was there and then just cancel. Okay, and put the new figure beside it. And then we're going to add that 2,400 onto our drawings. So at that stage, with drawings and up here purchases, we would have had a couple of red lines. There's not a problem doing that. Okay, your examiner is still understanding that you can still do rough work on the actual sheet itself without having to do it on the spare page. That's that one. Check for 800 received for in respect of debt of 800 previously written off as bad. No entry made as a result of that. So we received a check. So our bank is going to have to change. Bank is 16,4. So because we got 800, we're going to take that away from our bank overdraft because it's on the credit side, it's an overdraft. So we take away the 800 from that. And we would have written that off as an expense. So when we cancel the expense, when the check has come up, we'll have that as another income. So it's a bad debt recovered. Okay, so that's all of the adjustments done. And if you see, We've dealt with buildings, vans, investments, mortgage, patents. We haven't touched debtors and creditors yet. We haven't touched sales. We haven't looked at opening stock or advertising. We've dealt with salaries, provision of bad debts we haven't, or discount or rent, mortgage interest we've dealt with. Insurance we haven't, VAT we haven't, bank we have, PAYE, drawings and capital we haven't. So we've dealt with more than half of all the things here. So at this stage, in 20 minutes of a 50-minute question, we've already got probably about 40, we've probably got about 60% of the marks without doing any maths. That's stage one. I'll come on to stage two now.